Hi, good evening. Welcome to another episode of the Weekly Market Wrap. My name is Daniel Ang. Of course, today is April the 6th, the first weekend of the month of April. And last week, we have witnessed quite a bit of volatility in equity markets. And of course, the highlight was Trump's announcements of his latest suite of tariffs, what he labeled as Liberation Day. And immediately following his release of the amount of tariff that he's going to impose on the various countries, the market went into a tailspin, which lasted all the way to Friday. So, what's ahead? Now, before we get into the content itself, let me remind you that this presentation is not an offer to buy or sell any kind of securities. And definitely, we won't be talking about that. And let me see if I can call up. Can you see my screen? Can you see my slide? If not, then I have to redo this again. I'm not sure what you can see because I can't see my own slide. Anyway, let me unshare this and then share it again. Stop sharing and then I'll reshare my slides all over again. Hopefully this time you can see it. Right, as I was saying, this presentation is not an offer to buy or sell any securities, and definitely the trading of any kind of margin products do carry risk. So do understand your own risk tolerance before you attempt to trade any kind of margin products. And I'll be sharing with you my views on the various markets. And this time we will try, like I say, over the last 2 or 3 weekend, we have tried a new version. A new way to do this, in which I will very much prefer that you tell me what you want me to talk about, and everything will be subject to what's available on the IronFX platform because they are the main sponsor for this event. And of course, if you can tell me what you want, I will be able to share with you what I think markets may do. And of course, this content itself has not been vetted by any regulatory bodies, and just be aware of this fact. Now, we will go into this. And before we do that, I want to also acknowledge IronFX for sponsoring this event, which they have been doing for the past 6 months or so. And I fully appreciate what they are doing, and I hope to be able to do more with them. Okay. Right. Now, the first number that came out this past week has been a number what we call the manufacturing PMI. Now, remember the week prior, we also have a manufacturing PMI, but that was, of course, the S&P Global. So that was a different version, and this is the version that most people are actually concentrating on. And for the manufacturing PMI, both have the same result. We saw a pullback in the S&P Global PMI numbers that suggest that manufacturing in the States has gone back into contraction zone. Now, this has been confirmed by the ISM version of the same thing. The ISM manufacturing PMI for the month of March has actually shrunk back into contraction zone, meaning to say that it is now below 50, which is the pivot point. Okay, there's a couple of questions here. Let me see how are they. Cool. I will talk about gold as we go along later on. Thank you very much. So this is further proof that the manufacturing sector in the United States is basically struggling. Okay, of course, we all knew that the U.S. economy is basically a service-oriented economy, and of course, they are trying to pull out the manufacturing. And Trump's tariff policy has a goal in which he wants to reshore manufacturing back to the United States, and he using very punitive tariff. A very crude way to do this is to force nations that sells into America to set up factories within the Americas so that they can actually reshore the manufacturing sector. This is going to be very hard. And even if it succeeds, it will take years, okay, to find the land, to find the finance, to find the people to actually set up factories in any country, okay? So whether or not Trump will be around by then, that remains to be seen. Okay, obviously we all knew he's trying to seek a third term, and not sure why he wants to do that because by then he will be way above 80 years old. Not sure whether he has the energy to do this job, which requires a lot of energy. Okay, so Trump, being Trump, always wants to hang on to power. We will see whether his various policy will result in him able to see the fruit of the result that he has been trying to achieve. But we have seen the adverse reaction to his tariff policy. He has been in power for about 70 days now, since his inauguration day on January 20th. And we have been seeing that he has been creating a lot of volatility in markets. And we have seen the stock market has tanked under his watch. So whether or not history will judge him as the president that tanked the market deliberately. Maybe this is what Trump has always wanted, because among his few things that he wanted to see was to not only to narrow the trade deficit, and the tariff is one way to do so. And once he is able to reshore the manufacturing, assuming he succeeds, then he also wants the dollar to come down, in which he has been telling the Federal Reserve Chairman to cut interest rate. And the last time he mentioned that again was on Friday. And obviously that was after the Fed Chairman has made a speech in which he did not directly blame Trump for making his job that much more difficult, but he actually did briefly suggest that the tariff is not helping. So he don't see that there is any need to change policy just yet, and he wants to watch for further developments. And Trump followed that with a Karen call, basically telling him this is the time, do it now, okay? So basically, Trump really wanted a lower dollar. He wants to lower interest rates because he also have another agenda in which he needs the U.S. Treasury departments need to refinance trillions of dollars of national debt that's due to be rolled over in June. So he doesn't have a lot of time. He has less than 3 months to lower the interest rate. So by the time the US Treasury wants to roll over the old treasuries into the new one, he wants to refinance them at much lower rates. Okay, and this is the reason why he's so urgently wanting to cradle the economy, to force the hand of the Federal Reserve to cut rates. And I think that is something that he is very keenly aware that he is running against the clock. Okay, and so far the Federal Reserve is not playing ball with him, which may result in a conflict between the Federal Reserve and the administration. So we know Liberation Day was April the 2nd. That was a day after April's Fool Day, but the market is not laughing because that day when he announced the tariff, the market went into a spin. Okay, many markets started to move. And of course, the effect of the tariff will kick in by Wednesday this week. Okay, so do watch out for further volatility going into April the 9th, which is Wednesday, and this will be followed by the release of the CPI on Thursday. So between Wednesday and Thursday, expect the market to be very, very volatile. In fact, on the get-go tomorrow when the market opens, I do expect a follow-through of what we saw last week, and which is basically telling us that the equity markets in the States right now is in a waterfall situation in which, is practically we're going to see very rapid decay in equity prices, and that may last all the way to midweek with the possibility of a low, a temporary low by, I think, suspect it's going to be Thursday, because on that day we have the CPI release. Okay, so if that is the case, I do expect a bounce, okay, which may last 2 months, no, not 2 months, 2 weeks, okay, and then we will see another dip back to whatever the low this week is going to be formed. Okay, then watch out for the first week of May, in which I think that could be, if you're looking to go into the market, okay, maybe that will be the good timing to do so. Watch out what happens, okay, after a bounce followed by another 2 weeks of fall into either the first or second week of May. I think a bottom should be in place by then. Then I think it will make sense to look for buying opportunity in equity markets. I don't believe that we have seen the high in equity market just yet. So this move that we saw with the catalyst, with the tariff, I think is going to be something that will cause equity prices to retreat. Okay, the R word now is ringing very loud. People are talking about recession and whether the tariff policy of Donald Trump is going to be the catalyst that caused a recession? I think not just yet, okay? Because when we go into the month of May, this is where the real danger is, okay? Because May, we may see something more than just economic unfolding, okay? But we will go to those dates as we get nearer to those dates. Okay, we are only at the beginning of April, so let's deal with April first. So a lot of people has been looking at the last time the US has a tariff policy very similar to what Donald Trump is doing right now. And that act was a Smoot-Hawley Tariff Act. And that was enacted a long time ago, 1930s. Okay, I'm not sure anybody is still alive now. They have witnessed a similar pattern being unfold back in 1930. Now, of course, we all knew from history book that the in 1929, the year before this act was enacted, we already knew that U.S. equity markets hit a peak and it was already falling. Okay, that was the Great Depression, and I think this tariff act only exacerbate the decline in U.S. equity markets. I think at that time, I think the U.S. equity market fell by almost what 80%. So it's quite a very severe drop. Okay, are we going to see something similar to that? Maybe not yet. Okay, I don't believe that we have seen the high in equity market just yet. I think the market needs to go new high. Okay, to complete this series of moves before we see the big one. Okay, it may not be this year. Okay, just be aware that this decline that we are seeing in equity markets right now may give us another opportunity, in my opinion, that for those who have missed out the bull market in 2023, maybe this is one last call. This could be the last call to finish the sequence of rise from all the way from the pandemic low. Okay, so just be aware that a lot of people has been referring to this Smoot-Hawley Tariff Act to get a sense of where the market may be heading. And of course, when they saw what happened after the enactment of this act, they saw a massive sell-off in equity markets. So that's what analysts has been referring to, suggesting that this could be the one that will cause the US stock market to crash maybe as much as 80%. But personally, I don't think that's going to be the case. We are going through a period of transition. So again, I think Trump, despite his way of dealing with events, I think a lot of people may have underestimated him. I think he has a very clear goal as what he wants. He already said he wants a lower dollar, and in order to get a lower dollar, he needs the Federal Reserve to cut interest rates. And we already knew what the uh, the Fed chairman has been trying to tell us that he won't be looking to cut rates aggressively after he brought down the interest rate from 5.5% to 4.5% last year, in the last quarter of last year. Markets is expecting him to continue to cut, but he tells us that inflation seems to be a problem. It looks like it is reigniting, so he wants to watch the data. So what he's trying to say is that no interest rate cut in the near term. Okay, so what I think the Trump administration is trying to do is trying to force the hands of the Federal Reserve Chairman by creating an event like this. He knew that his tariff policy will cause an adverse reaction. So if this is the narrative that we have been reading from analysts about this tariff policy may actually bring about a severe recession. This is exactly what he wants, because if we have a recession, the Fed chairman will have no way that he doesn't cut interest rates. Then that will basically fall into the objective of what he is trying to achieve. A lower interest rates means lower dollar, and a lower dollar has served two purposes. One is to refinance treasury, which is coming due in June, a bunch of them coming due in June. And we're only looking at the government bonds that are due for refinancing. We also have to concern that by the end of the year, the corporate bonds will also have to be refinanced. So I think he's in his interest to bring down the cost of financing ahead of time, so that he can actually claim that the Federal Reserve and the US Treasury can actually refinance at a much lower yield. As it is right now, we are seeing the 10 years falling below almost at 4%. Okay, and we have seen quite a big move from there, because at the beginning of the peak that we see this in the in the aftermath of his re-election, we can see that the 10 years Treasury yield has shot back up. Okay, but now we have seen that the Treasury yield for the 10 years has actually come and is flirting with the 4%. If it goes below 4%, this will be suggesting that there will be more than 2 cuts this year. Okay, so this is the market moving ahead of events. So the last time the tariff was imposed, this is a chart going back all the way to the 1930s. You can see that the market peaks, the Dow Jones then was only 3 digit, 386.1. Okay, that was a peak in September 1929. Okay, and the market was already falling off very sharply. Okay, before before they enact this Smoot-Hawley Tariff Act, and that was only in the middle of 1930, which is basically 9 months after the market peaks. They introduced this bill, which actually caused the market to went down even further. Dow Jones at one stage was only 45 points. Can you imagine 45 points in the Dow Jones? So that was practically a wholesale collapse in equity prices, and that was the period of the Great Depression. But of course, in those days, the US economy is not so intertwined with the global market. This is basically a domestic affair. Okay, but now if we have something similar like this, okay, in the same magnitude, then it's going to cause a major global recession, or maybe even a depression. Okay, so during that time when this thing happened, the market actually went down quite a fair bit, from 386 down all the way to 45 in the Dow Jones, which is a massive move. And not only did the equity market went down, after they introduced the act, the Smoot-Hawley Act, the dollar actually rebound 40%. Okay, so do understand the correlation. Equity markets goes down, the dollar went up. Okay, so don't ask me why. Okay, so that was the result then. Will the same thing happen this time? Is something similar happen? That is the million-dollar question everybody wants answer to. Okay. Now, as we go into the midweek itself, we saw the ADP employment change. It was very good. Okay, the previous number for February was 77,000, the first estimate, and they came with a revision to 84,000 jobs being created. And consensus was for a pickup in number of jobs created to 105,000. It came in much better, 50,000 more at 155,000. Of course, this number will be subject to revision next month. Okay, but for now, we can see that jobs has not disappeared altogether, despite the Doge has been cutting government jobs all over the place. I think the effect of the tariff will only be apparent in the next few months when factories starts to lay off factory workers. For example, let's say, for example, if the demand is actually hit because prices has gone up, so nobody know exactly how bad is bad, but we all knew it's going to be bad. Okay, if prices start to escalate as a result of the tariff, and worst case, if countries that are subject to very high tariffs start to retaliate, then of course we're going to see domestic prices spiking. And if that's the case, demand should actually be curtailed, and that will have a cumulative effect on the level of production that's needed. And by then, if there's less demand for goods and services, uh, companies will cut down on employment. So the effect will be only visible maybe in the next quarter or so. So right now it's a little bit too early to say that there will be a direct impact, but I think everybody is bracing for that. Okay. So we also have the ISM services PMI, and this one also showed the same pattern. Last week we saw the S&P Global manufacturing services, the services PMI. It also decline. Okay, but this time you can see that the same thing also happened in the ISM version of the same thing. The services PMI also declined from 53.5 to 50.8. The difference between this and the manufacturing is that there was no revision. So the number was good at 53.5, but it was lower than market consensus of 53. It came in at 50.8. So again, we are seeing services is not as strong as what it was in the first 2 months of 2025. So we can see that there is a very clear markdown. I think by the time people realize that Trump is going to be using the tariff as his weapon of choice to actually tell all his trading partners to come to the negotiation table. I think some countries has already done that. Vietnam has been imposed a very high tariff, and among the I think the Vietnamese actually sent somebody to talk to the Trump administration, and they are basically open up their markets, okay? And we will see, because I think Trump is trying to get them to come to negotiate, come to beg for lower rates. And of course, you want to see what you can bring forward. I think it is not so much the tariff. Okay, I think Trump has a game plan at the back. I think earlier on, I did mention about the need to refinance the U.S. national debt. Bunch of them are coming for renewal. So he need to roll over those treasuries. So I think at the end of the day, while he did not, while it's not in the media, I suspect, I think he will lower tariff on those countries if they agree to buy more US debts. I think at the end of the day, right now the US has a problem because there's not enough buyers of their national treasuries, those bonds. Okay, so at the end of the day, the most direct way in which he said, "Come, let's negotiate. If you buy more of my bonds, I am more than happy to lower the tariff imposed on your goods." Okay, Vietnam is particularly vulnerable because during the last time when Trump did the tariff and was continued with the Biden administration, China has actually started to route their factories into the neighboring countries in Southeast Asia, namely Indonesia, Cambodia, Vietnam. Okay, these places where they have they stick a label which is not made in China. So those goods gets to go under the radar into the American markets. I think Trump has already realized this is the game that the Chinese are doing. So I think he is going to block all this by imposing very, very high tariff on all these places in which the Chinese has rerouted their factories. Okay, so we can see from here onwards, even Malaysia is also hit with 24% tariff. Okay, but according to news report, okay, Malaysia is not going to retaliate. They are not sending anybody to actively negotiate a lower tariff. I think they are just waiting, just telling to wait and see because nobody really knows. But I think the game plan is for all this country that has been hit with very high tariff to go to America and say, please, let's negotiate. What do you want? Okay, you want me to buy more national debt? I may be open to the idea. Okay, let's see what happens. But I think this is a game plan. Trump being a businessman, he understands leverage. Okay, so he using the tariff as leverage, as a bargaining tool, so that he can open up markets for himself. Okay, so let's watch out how this thing unfolds. Now, in the non-farm payroll, which is the most high impact data released for this past week, we can see that non-farm payroll actually increased. In the month of February, it was 150,000 jobs that was brought down, revised downwards to 117,000 jobs. Consensus was for 135 to 140,000 jobs. It came in very, very much better at 228,000. Again, this number should be subject to revision, if any, by the next release. Okay, so in the for time being, based on the number that we saw, jobs has not been lost yet. In fact, it has actually grown, okay, very much against the grain. Most people were expecting the employment to actually be hit, okay? So we can see that while non-farm payroll has rose, okay, the unemployment rate should correspondingly go down, but it has actually gone up to 4.2. Now, last year, the highest was 4.3. So are we in a situation in which this market may actually, this number may actually start to climb all the way above 4.2 towards 4.3? Okay, so right now what we are seeing here is this is matching the high of last year. I think once the market break above 1.2, we already know that we basically understand that employment is going to be a big problem going forward. And that will be so if we see more layoff by companies as a result of this very punitive tariff being imposed. The average hourly earnings, we have a mixed bag here. We have no change on a month-over-month basis. It was 0.3. Now, previously it was 0.3. They revised it downwards to 0.2. And for the month of March, it gone back up again to 0.3. So from 0.2 to 0.3, but previously it was 0.3. So basically, it is still not much of growth. In fact, the income of American consumers has not actually caught up with inflation just yet. Okay, on a year-over-year basis, you can see there's a marginal dip. Previous month was 4%. Market expected that to come down by a tick to 3.9, but it came in slightly better at 3.8. So 3.8 is the lowest we have seen over the last 7 months. Okay, though this is a good development, but when you look at consumer perspective, from business owner, of course, wages starts to climb is good news, but for consumer, okay, that is not necessarily a good news. We can see that for consumer, for workers, for hourly wage workers, you can see that the income has actually slipped. Okay, so that will definitely negatively impact their spending power going forward. Okay, so by and large, when we see these numbers, we have to prepare for the fact that US consumers may not be in the position to spend. In fact, we are beginning to see a bit of belt tightening going on because of this uncertainty surrounding the tariff. Now, this is the daily time frame. I only show you from beginning of last year to now. Okay, we can see that the Dow Jones has a waterfall move, very severe drop from Thursday to Friday. We can see this is one of the sharpest drops. In fact, some analysts were saying this is the most this is among the steepest fall, even going back all the way to 2020. So we are comparing to the pandemic crash. So is this going to lead to a major unraveling? Like I say, I do expect follow-through selling at the beginning of the week itself. Maybe it will last all the way to midweek with a possibility that somewhere between Wednesday and Thursday, we may hit a bottom. But I think this fall that we saw on Thursday and Friday is so sharp that it is quite logical to actually expect prices to continue to dip. Okay, so if you have not already sold, okay, selling now is a little bit hairy, okay, but I think there's scope for further losses ahead. Now, in the S&P 500, we also saw a very steep fall. Now, the market has an all-time high just less than 2 months ago. And now we can see that from 6,000, now we are already flirting with 5,000. So in just less than 2 months, we have saw a more than 1,000 point drop. So this is quite severe. This month alone, we already lost 9%. For the year to date, we are down 13.7. Obviously, this is not comparing to the high. Okay, if we compare the high to where we are right now, the total number of percentage loss is going to be even deeper. Okay, so this is the Nasdaq 100. This is among the worst performance in the US equity markets. Okay, you can see among the major equity index, this Nasdaq 100 is one of the worst hit. Now, last year, everything AI was the darling. Okay, but this year, all the seven companies that make up the Magnificent Seven, they are all seeing severe losses. Okay, so we can see that the sell-off in the tech stock has been particularly heavy. This month alone is down 10% so far. We still are only at the beginning of April. Okay, we are not even in the full week of April, and the market has already down 10%. So for the year to date, it's down 19%. So do expect to see more blood being shed in the tech stocks. Okay. Now there's some question being asked here. I want to see what they are. Raja Kumar, U.S. Treasury bond renewal periodically happen every year, right? No. Or is there any special reason why this year it is so high? I think now, if you remember, going into the pandemic, there were a bunch of US Treasury being issued. Remember, interest rate was almost at zero. So for the US Treasury to issue more bonds at such low interest rates, they have actually issued a lot of bonds. And that is not only the government issuing the bonds. The private sectors has also issued a record amount of bonds. Okay, but the one that is urgently on the table right now is for the US Treasury to find money or to find buyers for their new issue of bonds to roll over the old debt. Okay, so this has a legacy going back all the way to the pandemic low when interest rate was near zero. So they borrow a bunch of money at near zero interest rates. Okay, now interest rates is at 4.5%. I mean, the yield on US 10 years treasury, if you use it as a guide, is above 4%. So from near zero, you borrow now, you refinance at 4%. It's going to be very, very painful, right? So what they're trying to do now is to bring the yield down. And the yield has been falling since Donald Trump came into power. Okay, so that's also one of the reasons why Donald Trump wants the U.S. Federal Reserve to cut interest rate, because they cannot afford to refinance anything above 4%. That would be simply too painful. Right now, the U.S. is creating something like mm, 90 billion every 90 days. No, sorry, 1 trillion every 90 days. Okay, in terms of the debt is growing at 1 trillion every 90 days. This is very scary because we also have to worry about a compounding effect. Soon it will be 80 days for every $1 trillion. Okay, then it will be 60 days before they hit the 1 trillion mark. So all in all, this is totally unsustainable. So they have a debt bomb that can go off anytime if they don't find a way to refinance it at a much lower yield. Okay, and right now it is the wrong timing because U.S. allies such as the UK and the Japanese and the Chinese, they are selling U.S. Treasury bonds. So who is going to be buying? Americans themselves do buy their own treasuries, but I think it's going to be tough because right now we also understand that the guy who is advising Donald Trump right now sits as the chairman of his Council of Economic Advisor. Okay, this guy has a theory which I think Donald Trump has taken uh, verbatim. Okay, he is the one who come up with the idea of a leveling tariff and getting the people to buy century bonds. Okay, right now the longest duration of U.S. Treasury is 30 years. Means you lend Uncle Sam money for 30 years, and at the end of 30 years, you get back your principal. But in the meantime, they'll pay you interest. So what they are trying to do is to get all these people who buy all these bonds from the very short dated treasury bills all the way to the 30-year bonds and say, look, I want you to convert that all into century bonds, which is 100-year bond, okay, with no interest, and you cannot sell in the secondary market. Right now, anybody who buys US Treasury can actually unload them into the secondary markets. It's a very active and very liquid market. But right now, I think they are trying to change the narrative. Short of telling you the US is going to default, they say, look, lend me money for 100 years with no interest, and you cannot sell it to anybody else. Okay, so this is as good as telling the whole world US is technically bankrupt. Okay, so this is the situation right now. I think right now, if the tariff is too high for some countries to bear, maybe they will be forced to buy century bonds. And that is not good because US is technically broke. Okay, so this is the game plan I think is happening. Okay, so with the yield now right now hovering just above 4% for the 10 years, and later on when I show you the chart, it looks like it's steepening. Okay, and every time it's steepened, it has always led to a recession. So a recession is definitely in the card. Whether it happens now or happen at the second half of the year, we do not know. Okay. So this is the reaction in gold. Gold actually had a new high, okay, as a knee-jerk reaction. Now remember, gold actually closed at a record high in the last week of March. I believe last Sunday we talked about it, and I do expect this week the market to actually hit a high and then start to come off, and it did. The day after in fact, on the very same day when the tariff was released, okay, gold prices surged to an all-time high again, $3,167.71. This is basis the spot gold. Of course, in COMEX, the price is a lot higher, okay, and we can see that immediately after this high was traded over Thursday and Friday, gold sell off by $151 per ounce, or almost 5% from the top. So in just 48 hours after gold hit the top, gold actually came off $151 per ounce, or almost 5%. So this is big. So this is telling me temporary high is in place for gold. So don't try to buy gold at this moment in time. Gold prices, I suspect, is going to continue to decline all the way into the last week, maybe into the first week of either in the last week of April or the first week of May. Gold bull market is not over by any means. Gold has the potential to go way above $3,500, as much as $4,000 per ounce. So this could be a last chance to buy gold in a pullback. Very much like what I think is going to happen for equity markets. And if they all gel together about the same time, we could see a situation in which equity markets will rally back to new high, and we also see gold rally back to new high. So this is, I'm very excited. I think this could be panning out because the bull market in both the equity markets and the precious metal are by no means over. Okay. So I think there's a new question. Jim is asking, do I think the rise in unemployment to 4.2% is a cause for concern? It will definitely lead to inflation. Okay, all these tariffs is definitely going to lead to higher prices. So this one is already a foregone conclusion. And the question is, at higher inflation, what will the Federal Reserve do? Okay, will it continue to hold rates at the current level of 4.5%, or would it finally give in to what President Trump wants, which is lower interest rates? If that's the case, that could lead a fire on equity markets because lower interest rates means higher equity prices. Okay, 4.2, I think, is not the peak. Okay, I think we're going to see a lot worse before it gets better. Okay, definitely we're going to see a bunch of layoff. We're already going to see a bunch of layoff in federal workers. Okay, Dodge has been doing a fantastic job. Trump has basically shut down the IRS. Can you imagine that they actually shut down the Inland Revenue Department? Okay, and he's going to replace that with an external revenue department. Okay, so this he hopes is going to come from the tariff that he expects to collect. Okay, so there's going to be a bunch of layoff that's already happening at the federal level. Okay, those who work in government departments, a majority of them has been laid off. Okay, and eventually the private sector will also have to negotiate these very treacherous waters, not knowing exactly how to react with all this tariff flying around. Okay, so I think it's almost inevitable we're going to see higher unemployment rates. Okay, we are beginning to see people talking about a higher inflation, lower economic growth. Now, this is exactly the definition of a stagflation. We may not get a recession, but definitely we're going to get a stagflation in which we're going to have the worst of both worlds, in which prices remain elevated and we have lower economic activities. Okay, so this is the worst nightmare situation. So for gold, I do expect in the following days and weeks, we're going to see a pullback. Like I said, perhaps either into the last week of April or the first week of May. I think the timing is going to be very much dependent on what happens on the war front. I think the reason gold is elevated is that uncertainty or the fear. And I always say before massive war breakout, the money runs first. Okay, follow the money. And I think the situation in Ukraine is not any better. Likewise, the situation in Iran, in the Middle East, is definitely not good because we already been receiving reports that the US has sent another carrier group into the Middle East, and they have stationed 6 to 7 stealth bombers, which are capable of carrying nuclear weapons. Okay, so the thing is, are they going to hit the Houthis or are they going to hit Iran? A lot of people are thinking that they were going to hit the Iranian, and if that's the case, that will escalate the situation in the Middle East, and that will be the catalyst for gold prices to surge to all-time high again. Okay, so I think at best we have 1 month, maybe less than that. Okay, before all this that I fear will happen may actually pan out. Right, crude oil has also fallen off. Now, for crude oil to fall more than 7% is very unusual. This past week, we saw crude oil lost 10%. Okay, unfortunately, I have the misfortune of buying just before the market collapsed. Okay, I was actually buying on the way up, and this market came off. Okay, but I am still hanging on to my because it has not hit me out on my stock. But you can see the decline in crude oil has been really severe. Okay, among the price action we have seen all the way back to the beginning of last year, we can see that there isn't such a sharp move. Okay, this is definitely expectation that all this tariff is going to lead to a global recession in which demand for energy will be curtailed. If the world go into a recession, there will be less need and demand for energy products. But this is contingent on nothing else happen. Like I just mentioned, if the situation in the Middle East escalate, crude oil prices will rally back up again, okay, in no time. So I'm hanging on to my trade in expectation of able to maybe add more position at a lower level, and hopefully that will be enough for crude oil prices to rally again. There's another question. Let me get this new question. Tanvi is asking why and what has caused the tech stock falling out of favor. The answer is DeepSeek. Now, remember last year, out of nowhere came an AI company from China that's able to do what OpenAI is doing for a fraction of the cost. And shortly after DeepSeek, many Chinese AI company came out and said, look, I have designed an AI agent that can do this, can do that, and is free. Now, remember the OpenAI model, it has a paywall behind it, okay? And then when the Chinese AI company came out with something equivalent and it's free, it basically destroy the business model for all these AI companies. A lot, hundreds and billions of dollars are invested in those high-end chips that NVIDIA is producing, right? So suddenly, the world no need to pay any cents, pay any money for access to AI models. So the AI story suddenly is over. And when you talk about AI now, the narrative has shifted all the way to China. And that's the reason why since DeepSeek drama, okay, we can see that Hong Kong equity markets, Chinese equity market has been rallying, okay, because the AI story has been hijacked by the Chinese. So that's the reason why, okay, the tech stocks now is seriously overvalued, okay. Way on, okay, why on? What will happen to the financial market when Trump sacked the Fed chief by force? Well, it's not so easy because theoretically there is that firewall in which the Federal Reserve is supposedly independent. Okay, so whether Trump can actually sack the Federal Reserve chairman, uh, theoretically is cannot, but I think he can make his life miserable. Okay, so not sure. Well, we will cross the bridge when we come to it. But if that actually happens, if let's say, for example, the Federal Reserve refused to cut interest rate when Donald Trump wants him to cut interest rates, and the Fed chairman term will it's not due until I believe 2027. Okay, so theoretically he has time. Okay, he know he's untouchable, but again, there's no precedent of the president's firing the Fed chairman. So nobody really know. But the psychological impact is definitely going to be negative. Nothing good will come out of it. Okay. And of course, there have also been rumors about Elon Musk recommending that to shut down the Federal Reserve. That is even more dramatic. Okay. Instead of firing the Fed chairman, they just simply shut down the Federal Reserve. Is that possible? It won't. The Federal Reserve will not go down without a fight. That's for sure, and that is definitely going to cause even more volatility in markets. Okay, and Mr. Kumar here is asking the new tariff affects the manufacturer outside USA and support the local manufacturer. No, that is not true. Okay, what Trump is trying to do is trying to get all these countries that export goods into America to set up factory and manufacture those goods inside America. That is his ultimate goal, not to get the existing manufacturing to produce more. Okay, because manufacturing has been hollowed out many years ago. Okay, businesses only seek profit. So if somebody else somewhere else can do the job better at lower cost, why do it locally? America is no longer competitive. For one, their cost of production is high, the labor cost is high, then they have very militant unions, for example. And this is the reason why companies like those automakers in the States have started to produce auto parts in other parts of in either Mexico or in Canada. Because The union is so militant, and once they have to bend to the militant unions, cost goes up. So even if they can reshore the manufacturing, they'll be overtaken by what is currently happening in China. China has been so advanced in industrial robotics. Okay, have you known or have you had read story about automakers in China? Xiaomi has actually have dark factory the size that is even much bigger than the gigafactories that Tesla is famous for. So in a factory whereby there is no human inputs, the robots produce all the goods 24 hours a day, 7 days a week. So even if they can reshore the manufacturing, the jobs will never come back. Okay. And I don't think the US has advanced so much in industrial robots to the point whereby at the same level as the Chinese. So even if they can bring back the manufacturing, it's just not going to bring back the jobs. Those jobs are long gone. Okay, uh, you need new skills to run truly robotic factories. Okay, skills that Americans do not have. So this is where the catch is. Okay, in my opinion. Uh, so why would the local material lay off? Like all those reasons that I just given. So the recession may occur outside United States, not within United States. Is my understanding correct? No. If let's say for example right now, okay, now we take Europe and America as an example. If there is an economic slowdown, US may actually experience a recession, but in Europe it's going to be worse. For one, they have no access to cheap energy anymore, and the other one is that they have pivot uh, to a war economy. So if things don't pan out right, US may go into recession, but Europe will go into a depression, which is even worse. Okay, so it's not about whether the recession happens outside the United States. It's going to be global. Okay, all this tariff is definitely going to impact every countries in the world. Okay, and this is definitely going to lead to lower demand. Okay, and it's definitely going to cause price to go up everywhere. Okay. Anonymous is asking, why do I think gold pullback will continue until last week of April or early May? That is my timing model. Okay. There is the possibility right now for this coming week. Okay. I do expect gold to continue to decay. Okay. Because right now what we are seeing, there's a massive sell-off in equity markets. And later on, I will show you a piece of news that came up by JP Morgan in the on on Thursday, when the market was selling off, talking about equity markets selling off, retail investors has gone in to buy the dip, okay, and it was an amount that was amazingly high. So in my opinion, is that the retail trader is always the last to know, and they are always the last to get in. Okay, so this is not buying the dip moment. They have bought in too early. Okay, so right now they are having margin call. So where do you top up your margin call? Based on previous experiences, you will close out those positions that you have profits in and take those money to top up your margin call to support your bad position, your losing trades. Okay, this is exactly why gold prices is also coming down just when this trade war is escalating. By right, it should be rallying, but it's coming down right now. Okay, because another market is dying, which is the equity market. So they're taking a good position, close out the position, take the money to top up to hold their losing trades in equity markets. So this is going to continue for a while, and I think the whole of this month, I would say the whole of this month. I think for the next 2 weeks, okay. So the next 2 weeks will bring us to somewhere in the third week of April. Okay, if you go back to history, you check every time there is a pullback, how deep and how long is a pullback? Anywhere between 10 to 14 days. Okay, so you have to watch those repeated pattern. So that brings me to somewhere in the either in the middle of April or third week of April before we see a bounce. Okay, and then this bounce is going to be a dead cat bounce, be followed by another drop. Okay, which bring us into the first or second week of May. So this is, I think, what I think is going to happen. Again, this is just my opinion. Okay, natural gas. Okay, let's see whether I will be able to run natural gas. Anonymous is asking. If I hear you correctly, that I mentioned that after the sell of US equity, will I continue to rally like go? Do you have an estimate timeline? I actually do. Uh, like I said, I do expect the geopolitical situation in either the Middle East or Ukraine to escalate. And that will be one of the key reasons why gold is going to rally again. Okay. So uh, I suspect it's going to be in the first or second week of May. So if you are going to look to buy either gold or equities or to reposition yourself back into equity markets, you want to do it at the latest, maybe the first weekend of May. Okay, I think that will be somewhere about right. Okay, so again, we have to look at the price. Okay, look at the price and look at for the reversal. All right, let me continue. So this is the dollar index. You can see the dollar index has been falling since the beginning of the year. Now, this is leading to the Donald Trump rally. Okay, uh, Trump was expected to win, and he did win, and the market was euphoric. It took the dollar index all the way to the high of 109. Now it's at 100. Okay, not exactly 101, 101. Okay, so we can see the dollar index has actually come off quite dramatically. Okay, now in the case whereby equity markets are falling, okay, dollar falls in tandem with the fall in equity markets because that is a reflection of foreign foreign buyer of US equity cutting loss and also getting out of US markets. Okay, because if they do that, they have no they'll be looking to buy back their own currency. If let's say I'm a European, for example, I have euro and I want to invest in US equity markets during the phase whereby Donald Trump win and everybody was thinking that he's going to bring a new season of another rally. So now that we can see that the US equity market has been falling for the last what for the whole of March, and then in the first week of April, we saw that massive sell-off. Now they have no confidence; they just want to get up. Okay, so what they do, they sell off their U.S. equity, and if that they have no need for dollars, so they will sell the dollar and buy back their own currencies. Basically, this is how the market is interconnected. So we can see the dollar index is coming down. And are we likely to see even lower dollar rates? I think we should be able to see lower dollar rates going forward because this one is quite steep. Okay, in exactly 4 months, okay, we can see this dollar has been selling off. So are we going to see a bit of a rebound? Yes, I think we are beginning to see a bit of a rebound in currencies, and let me say currencies may pull back a little bit in the beginning of the week. Okay, so this is the U.S. Treasury. Oh, I'm supposed to have another chart. This is the chart that I want to show you. So this one has two bonds. Okay, one, the blue line represents the 10 years. The red line represents the 2 year. Okay. In a normal market, the rate is above. This is the inversion. Okay. The inversion is if you want, just put it this way. If I'm going to be lending money, or if I want to buy debt, for example, I want to be compensated more for the duration I have to hold the debt instrument. 10 years represents higher yield. And if I borrow on the short end of the curve, I cannot demand higher yields than the 10 years. So this is abnormal. This period here is really abnormal. What I call the yield curve inversion. So now the market has uninverted itself. Now this is the normal relationship. When the market inverts and uninverts, history has shown us every time this happens, a recession always happens. So this is also one of the reasons why people are talking about recession. Okay, so right now this is the relationship that's normal. This one is abnormal. But when you go for an inversion to an uninversion, this is where the danger lies. Okay, so we can see that now the 10 years is at 4, just sitting at 4%. The 2 years is sitting at about 3.6. So we can see that this is the normal gap. So this part here is normal, this part here is the abnormal part. Okay, but the fact that the market has uninverted itself, going back to going for total inversion to a regular correlation, this is where the market is staying at. Based on historical pattern, it always leads to a recession. So this is something that we have to consider. And of course, the rates is coming down, okay, because people expect the Federal Reserve now to cut more than 2 times this year because of the fear of recession. If the US economy, I know, if the US stock market tanks, it will also logically means the US economy will be in trouble. And the Fed has a dual mandate. Either you control inflation, although you the other one, of course, is you make sure the economy chugged along. Okay, and if the economy is likely to slip into recession, you will have to lower interest rates. So that is the whole idea. Huh? Now this is something very interesting. 3 weeks ago, Morgan Stanley came and said the risk of a recession is 40%. Now remember this date here. This is the middle of March. At the end of last week, okay, barely 3 weeks later, they raised the odds of a recession to 60%. You can see this is April the 4th, Friday. And this is between the two headlines. It's only 3 weeks. For JP Morgan to actually change the estimate by 50%, okay, from 40% to 60%, they have actually thinking that the recession is a lot more likely to happen. So this is telling us market is very, very concerned. Okay. Today, if you have seen the social media, there's a massive protest right now going on in the States, okay, against Donald Trump. Massive, okay. Of course, we do not know how many of them are Democrats, but again, we can see that people are definitely very, very concerned, okay. So on Friday, okay, after the non-farm payroll numbers has been released, the Fed chairman actually spoke, okay, and I think he's referring indirectly to the tariff. Okay, and he said while uncertainty is high and downside risk has risen, the economy is still in good place. This sentence alone means don't expect rate cut immediately. Okay, then the size and duration of the effect of the tariff remains uncertain. That means to say that he's not sure how bad is bad. Maybe it's not that bad. So he said he needs time to monitor. In short, don't expect the Federal Reserve to cut interest rate anytime soon. Okay, it is too soon to say what will be the appropriate path for monetary policy. Now, this is as clear as daylight. Okay, this sentence says that it's too early. Okay, for him to make a judgment call. Then say while tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible the effect could be more persistent. So all in all, he's talking about inflation. He's only concerned about inflation. He's not even considering the possibility of recession just yet. So if his focus is on inflation, and we can see inflation likely to be elevated as a result of the tariff, then expectation of an interest rate cut anytime soon is out the window. So this is what he says. And then following what he says, hours later, Trump said, this will be the perfect time for the Fed chairman to cut interest rates. Now, he's not even hinting anymore. He's telling me, cut interest rates, stop playing politics. Okay, he even tweet on this. So we can see that Trump definitely wants a lower interest rates. Okay, so he has a game plan, tank the economy, force the hand of the Federal Reserve to cut rates. And if the Federal Reserve actually cut rates, then the US Treasury can actually refinance the mountain of debts that's coming by June to be refinanced at a much lower rates than what it is right now. Okay, so if over the next 3 months he don't get lower interest rates and the Federal Reserve of the US Treasury is forced to refinance at higher rates, and that's assuming he can find buyers. Right now, buyers are hard to come by. So the tariff is purposely placed at very high level to force all these countries to come back and renegotiate with Donald Trump. And Trump will probably tell you, if you want lower tariff, buy my century bonds. I think that is a game plan because he's getting desperate. Okay, so whether we're going to have a full-blown recession accompanied by an escalation in the war in either the Middle East or Ukraine, all these are going to add fuel to the fire. Okay, so this year is going to be tremendously volatile, in my opinion. Okay, Jim is asking, do I think the reversal in US equity by May will be long term or will we see lower lower lows after that. Like I said, the sequence of the pattern that we're seeing from the long-term perspective suggests that the rally in US equity markets starting with the beginning in the March of 2009. That sequence of rally from the low in 2009 as a that was the global financial crisis low. Okay, that sequence needs another high. This the pattern suggests that we probably will see another high beyond what we are seeing currently, and this will be the last phase before the big one comes. Okay, after that phase is over, okay, the market will be due, it's ripe for a more meaningful pullback, very deep pullback. Okay, but for now, I think we just have to concentrate on whether we can actually engage the market on the long side should the reversal come and ride it beyond the all-time high and then some. Once the market goes into all-time high, we just have to monitor the sequence of patterns that unfold after that, and then make sure that we get out before the market peaks. That's it. Okay. Whether the next fall is going to be deep, I think it will be very deep. Okay. Remains to be seen. Okay. All right. Hope I have answered your question, Jim. Okay. But soon. Okay. Why Aussie thanks so much against dollar? Later on, when we go to Aussie, I'll talk to you about it. Okay. So let's continue. I have already overshot my time. Okay, this is the piece of news that I was telling you earlier on. On Thursday, when the market was falling apart, retail investors go in to buy big time. This is a record amount of investment the retail investors had actually poured in. Okay, and it's quite sad. Whenever the retail investors get in, like this, okay, it usually means, okay, they are too early in the game. Okay, it means they are trying to buy the dip. Buying the dip is not wrong, but I think the timing is so much displaced. I do see an acceleration to this fall that we saw last Friday. I think it's going to continue this week until perhaps Wednesday or Thursday. So can they tong or not? Okay. So if they cannot, they meet more margin call, it will lead to more selling of gold. Okay, to top up the margin call. So all these are interrelated. Okay. So we can see that a lot of people are also evenly split. They either buy single stocks or they buy the ETF. Okay. But both will be equally hit this time. Okay. And they say it's too early to tell whether this deep buying will work in favor of investors. Okay. In my opinion, I think it's a little bit too early. They have gone in to buy the dip too early. Right. Now, this is the part whereby you can tell me what you want me to talk about. We'll start off with equity markets. 5 seconds. Tell me what you want me to talk about. Hang Seng. Okay, we talk about Hang Seng. So for those who wants to hear something else, you gotta put your preference into the Q&A. Hong Kong market, S&P 500, gold, and China A. Unfortunately, I don't have China A on this platform. Okay, but I will talk about S&P. Okay, I think we start with the US equity markets. For that, I need to share with you my platform. Can you see my MT4 platform? Let's talk about S&P 500. Okay, Dow, Nasdaq. Yes, I will talk about the three major ones. Okay, please let me know if you can see my MT4 charts. Type yes if you can, please. So I know that you can see what I want to show. Thank you very much, Tanvi. Okay, well, we start with S&P 500. Now, this is the long-term outlook, okay? The market remains very bullish, okay? So this is March. The whole of March, the market has tanked. But before March, in February, the market topped out at 6,149.87. Now, of course, this is referencing the MT4 pricing on the IronFX platform, okay? Then March, we saw that pullback. Now, remember, going into the end of March, I said this is a potential reversal, which is a classical reversal, right? This one is actually the what we call a doji, okay? And the doji happens by taking out this marginal high and then turn around. So this is usually what we call a fake out, okay? Basically, the market is trying to trigger all these people who put a buy stop here, And if you're unfortunate to have bought the high, now the bull trap is closed. Okay. Uh, we are only in the first week of April, and we can see that the market has already sold off more than the entire month of March. And this is definitely quite severe. The market closed near the low so far for the month. Okay. Remember, this is only accounting for less than 4 trading days in the month of April, and it's already so long. So it's just logical to expect continued losses ahead for the S&P 500. Now, this is a retail investor, a more retail-oriented index, which is the S&P 500. So from the report that we just saw, Morningstar says that on Thursday, there's a bunch of retail investors going in to buy the dip, okay? And then Friday, we have another massive sell-off. So definitely they have already bought too early. Okay. If they can hold all the way to, let's say, the first week of May, maybe they can come out alive. But if they cannot, then they will have to cut loss. And what will happen after that? Worst is they decided the market is going to go down, then they start to sell, and then the market rebound and go new high. That will be uh, the ultimate. Okay, I've seen many times these things do happen. Okay, you hold on until you cannot hold on anymore. You cut loss, then you turn selling, and the market rebound. Okay, and then not only rebound, it goes into new high, and then you say, this market is impossible. Okay, here, technically speaking, on a monthly time frame, this is what we are seeing. Now, let's take a look at the weekly, which is more relevant, in my opinion. Weekly, we can see that there is massive sell-off. Okay, this past week has been very, very deep. From 6,150 now, the market is hovering just above 5,000. So the market has practically lost 1,500 points. Okay, in how many weeks? In 7 weeks. So this is a bit scary. So going forward, where will the market hit to? Now, I do expect market to actually deepen its fall. Okay, where it stopped, I do not know, but the immediate target for the weekly time frame suggests that there's a possibility of market decaying all the way to 4,570, which is this projected target here. Of course, if the market ever go into this lower end, which is what we call the very deep retracement line, that will be a bonus. Okay, whether it can do that, I do not know. Okay, we will have to wait. But if it does, then I know that I'll be looking for buying signal. So this is the daily time frame. Daily time frame has already turned bearish. Okay, right now there is hope that this is just a simple corrective pullback. Okay, this is 3 wave. Okay, I'm not going to be very exact. I'm just going to be agak-agak. So A, B, C, it has hit its 100% target. Okay, with the possibility of extending a bit lower. So if this thing extend all the way to 1.618, then we know that this is something even more dangerous. How do I know? Because if the market extends all the way to 1.618% of its peak, then we are possibly looking at a potential unfolding of a 5-way pattern. So if this is the case, market continues, cannot stop where it is right now, which I don't think it will, okay, and goes down to 4,757. This is 1.618 bare minimum. And if this is being hit, then there's a possibility we'll see a much deeper and more aggressive sell-off, maybe even below this level. Then I know that will be part of the most aggressive move, which is part of a 5-way pattern. So either way I look at it, whether it is going to be a corrective or whether it's going to be an extended fall, okay, it's very clear to me. I just want to see how the market reacts, but I think it will be deeper, much deeper, okay, to 4,757 at the bare minimum. So this will be my immediate target for this, because considering the momentum behind this week fall, okay, we can see that on Friday especially, okay, this suggests that we're going to see an extension of this fall. Okay, this is my 2 cents worth for the S&P 500. Now let's take a look at the Dow. The Dow is by far the last to move, okay? Again, this is reflecting 4 days of actual trading for the month of April. This is the entire trading month range for the month of March. Okay, so this is telling us that we are in the early part of this deep pullback. The underlying trend is very, very strong. So the bull market is by no means over. What we are witnessing here is only a corrective pullback so far. Okay, this is based on the monthly. We cannot see too much into it because we are only in the early part of the month. Ku is raising hand. Ku, what do you want me to do? You want to talk there? Can you just type your question into the Q&A? Thank you very much. Okay, this is the weekly time frame for the Dow Jones. Similar pattern, okay, but I think it is already more than 1.61. You can see one, two. If this one is a three-wave track, then it should end somewhere here, okay? But it has extended of this past week all the way to hit the 200%. So this is already deeper than the classical 1.618. So it's 200% and it can extend to 2.618. If that's the case, then I think we are seeing something a lot deeper than the market is telling us right now. Okay. Just be aware, further losses, very, very sharp losses is right ahead. This is a part of a waterfall move. A waterfall means the market went vertical, okay, all the way down. Okay. So this is the pattern is telling us expect more severe losses in the days and weeks ahead. Okay. This is suggesting momentum. Okay. 200%. This is the wave one, followed by a pullback. And this is so deep, it has already hit beyond 200%. I suspect it will go easily to 2.618, maybe even 3.618. So if the market breaks 37,232 on the daily time frame, the Dow Jones will go negative. The S&P 500 on a daily basis has already gone negative. Let me say that now the market is favoring the downside. So the only level to hold the Dow Jones on the daily basis is 37,232. If this level is taken up even by one tick, okay, I will have to eliminate all the green boxes and keep only the pink, meaning to say that the market now favors the downside. Okay. Wow. So many questions now. Let me grab this question first. Raja Kumar is asking from the chart is how to identify whether retail investors are buying heavily. I don't know. On the chart, I can't tell. I can't tell. The piece of news where it says retail investors bought on Thursday did not come from me. It came from a report from Morningstar. Okay, Morningstar is a journal. It's a company that tracks hedge funds. Okay, so that is coming from a very authoritative report. So I have no way of telling the retail investors where they buy. I don't have this skill. Okay, Anonymous is asking, my screen sharing has paused. Has it still been paused? Can't see the weekly, at least not on my chart. Okay, let me see. If that's the case, I have to reshare again. Not sure why that is the case. Can I unshare and come back? Stop sharing and share again. Okay, can you see the chart now? The chart is not moving, the sky is not sure. All right, thank you. No wonder these guys are messaging me. Okay, now you can see, right? Thank you very much. Let's move on to uh let's move on. I want to show you the European markets. I'll show you the FTSE 100. Okay, monthly time frame, the market has picked up at 8,909. Okay, so we are also looking at the same thing right now. Okay, the equity markets in UK pick out the last to pick, okay, was in last month. And now we are seeing 4 days of trading in April, and it's already quite long. Okay, this bar is actually quite severe. So when we look at the other time frame, the lower time frame, which is the weekly, which is more relevant, we can see that not only are prices coming down in the States, we are also see equity prices unfolding rapidly in Europe. Now, Europe has been doing a much better job in terms of the equity markets outperforming the US market for quite some time now. And now they are playing catch up. Because this tariff, now we are waiting for the EU to come back with a response. EU says that they will launch countermeasures. Not sure what that means yet, okay? But if that means buying less from Europe, buying less from US, maybe the impact on the EU will be quite severe, okay? So the market is nervous right now. They are simply taking out the money from equity markets for the time being everywhere. Okay. So this severe sell-off in equity markets in the UK, okay, see how Friday one day itself market has sell off so much. Okay, so again, this is a confirmation of the pattern that we are seeing. Even the German DAX is doing the same thing. Okay, here we have the German DAX on a weekly basis, very severe sell-off. The market peaks in, I believe, in February, 23,489.78, and we are seeing the sell-off as this is happening. So the equity market is the worst place to be in right now. When you can see price like this, okay, do not go in to buy just yet, because you need to have evidence that the buyers are in before you attempt to buy the dip. You cannot just buy as the market is falling. Okay, it's suicidal. Okay, so on the daily basis, if the German DAX breaks below 19,665.3, this entire chart is going to flip. So this is based on the daily time frame. So we are beginning to see the same thing, both in the US equity markets and the European markets. Now let's take a look at Hong Kong. Now again, Hong Kong, remember last Sunday, we talked about this. The market ends with something very similar that we saw in the Dow Jones. This is the same pattern, and it follows a three-wave rally. I was suggesting that maybe the top is in place for the rally in Hong Kong market. Okay, and don't forget the Hong Kong market and the Chinese market will close on Friday for the Qingming. Qingming, for those who are not Chinese, Qingming is a big thing in Hong Kong and mainland China. Okay, whereby they will go and sweep the grave, means tidy up their gravestone and also of their ancestor. So when the market reopens tomorrow, that will be the first full trading days for both the Hong Kong and the Chinese market. So do expect a downward move, okay? Because as much as the Chinese has slapped an equivalent amount of tariff on US imports into China of 34%, the damage that's going to be done on both economy will be equally bad. Okay, there's no winner in a tariff war. Okay, so right now China is playing tough. Trump was hoping that the Chinese will come back and renegotiate. Okay, he has openly said that maybe he can get the Chinese to agree to sell TikTok, then maybe he will lower the tariff. There's no guarantee that will happen. The US has become so unreliable that whatever they say, even in black and white, they can ignore it. Okay, so if the Chinese say, okay, I want to negotiate, and then they want something from China, maybe asking them to convert their 700 billion worth of US Treasury and turn it into century bonds. That will help. Okay, then maybe the US will lower tariff. But there's no saying the US cannot ram up the tariff after they get what they want. Okay, so the Chinese is definitely not going to play ball. So right now we can see the Chinese is playing hardball. You slap me with 34% tariff, I slap you with 34% tariff, and then let's take it to the wall. Okay, so right now Trump is in a situation whereby China has caught its bluff. So it puts the American now on a back foot. Trump said, do not retaliate, because if you retaliate, I'm going to up the tariff. Currently, the US tariff on China is already at 54%. Even if Trump said, I'm going to slap you 100% tariff, it's meaningless, because China simply said, I'm not going to sell anything to you. Okay, so if he upped the ante by slapping a higher rate of tariff on Chinese imports into America, it is meaningless. But the worst that can happen is that after he said, don't retaliate, because if you retaliate, I will double your tariff. What if he didn't do that? That means to say, it's like a game of poker, when you call when you say show hand, the other side refuse to show hand. Got nothing else to show you. So if that's the case, now the EU has not made known their countermeasure. And if they see the Chinese are playing hardball and the US never increased their tariff on Chinese imports into US, maybe they will do the same thing as the Chinese. And that would be bad for Donald Trump, because basically they're calling him bluff. So right now, based on what we have seen so far on the tariff front, we have a technical three-way bound followed by a key reversal. This is quite a classic reversal pattern. So we have not seen the reaction yet, because last Friday was Qingming, which is a very important Chinese holiday. So market will come back full force tomorrow morning. So let's see if this is going to result in a major crash. Now, I've seen something like this back in 1987. In 1987, they call it Black Monday, okay? Because the world went into a contagion whereby stock market went to limit down move 5 working days consecutively, okay? I have not short the Hang Seng, but I'm really short the Nasdaq and the S&P 500. Okay, so if this pan out to be something similar than what I saw back in 1987, because people are talking about maybe we are going back to 1929. What happened in 1929? That was the Great Depression. Okay, but I don't think it will be that extreme just yet. Okay, just going back to 1987 is already very scary because in percentage term, that was the biggest sell-off in recorded history on Wall Street. Okay, percentage term. So is this going to be the case when market opens tomorrow? I have no idea, but it does look to be deja vu to me. Okay, so this is what I think is going to happen in the Hong Kong market. Is likely to see a follow-through selling. Honestly, I don't think it's good for China. It's not good for Hong Kong. So this is a three-wave rally, ends at 123.6%. Classical uh, symmetrical three-wave rally. Okay, then followed by 3 days of losses. Even if you look at the daily time frame, you can see the pattern is quite severe. This is only the first leg. Tomorrow, the market may actually gap open with a big gap to the downside. Okay, because they miss out Friday's move. So tomorrow, don't be surprised the market actually opens with a gap down. All right, I have covered the Hong Kong market. Any other markets that you want to see in the Asia Pacific region? Can I repeat the Dow Jones 30 analysis because I can't see your screen? Okay, one last one. Okay, I shouldn't go back and forth because if I've already covered that, I don't want to recover that again. Let's see. S&P or Dow Jones. Sorry, Dow Jones. Okay, this is the Dow Jones chart. Let me resize this. Why am I having so many windows? Something is not right. I shouldn't have so many windows. Anyway, I have Hong Kong. Very funny. Okay, let's take a look at the weekly time frame. This is the Dow Jones weekly. Yeah. Okay. So I was saying that this is a three-wave move, and if it's symmetrical, it will end somewhere around here, just marginally below this low here. But it accelerates to 200%. It means this move here is 2x already. And this is definitely a definition of a very impulsive move. So 200% does not look like it will hold. I think the market may actually go all the way down to 2.618 at a bid the next stop. 2.618 followed by another bounce, followed by another dip. Hopefully that can end in about 2 weeks' time. Okay, so first a fall this week. I think this week the low in equity markets, whether it is Dow Jones, S&P 500, or even the Nasdaq, I think it's either going to be Wednesday or Thursday. Okay, most likely on Thursday because Thursday we have the CPI numbers released. So look out for a bottom somewhere near Thursday. If you see a classical reversal signal, that is part of a five-wave move. If this is already 200%, I think there is a possibility the market will go down a bit lower to 36,200, and then followed by a three-wave bounce, followed by another drop to whatever the low is, and that will complete the five-wave move. Then will follow by a three-wave move that will also last typically about 2 weeks. That will bring the market rebound back to the first week of May, and then followed by another sell-off. Okay, so do not buy this dip just yet because I don't think the timing is perfect. Yes, we could see the entire move. Okay, hopefully that is enough for you because I don't want to spend too much time to revisit the old charts. All right, let's go into the currencies. As usual, we can see that the currencies Okay, in the monthly time frame, this is the chart pattern, three-wave bounce. Now, the euro is long-term bearish. This bounce that we see from 0.95 is part of a corrective move, probably gunning for this level at 1.23 half. Okay, and then if this is a three-wave, if the market goes into this bracket of prices between 1.19 to 1.23, that will actually be very close to this peak here. So I think there is scope for the market to go in this manner, A, B, C. At the bare minimum, 1.19. Okay, but anywhere between 1.19 to 1.23 could be where the ultimate destination is. So this is my euro outlook. I think the lower time frame is going to be quite meaningless because we already see the bigger pattern. So will that be also the same as in the sterling? Sterling is also doing the three-wave move, okay, but it's losing a bit of steam last week. Okay, so by and large, you can see that this is possibly where we are. Whether or not the market can go beyond 1.42 half, which because previously the market has been kept below 1.4375. Okay, the last time the market tried to challenge this high 143.75, the market can only do 142.60 and then drop all the way to 1.035. This is part of a very long-term bear market in the sterling. This is a long-term bear market. So just be aware that this bounce is only a corrective bounce. Although it has potential to go to 1.48, but I think look out for resistance around 1.42 half to 1.43750. Okay, so quite limited, but basically we should see the market struggle all the way higher. Now on the dollar yen is obviously very clear. Okay, this is part of a three-way pullback and the dollar versus the yen. Three-way pullback will ensure that dollar yen eventually will break 139.60 and perhaps go into either 136 half to 131.20. So this is part of a larger corrective pullback. And we can also see that the dollar immediate bearishness can also be seen in other currency pair, such as dollar Canadian. This is the weekly time frame. Maybe I should show you the monthly first. Now, the dollar long-term movement is up. Okay, that one I have no doubt. Long-term, the dollar remains very, very well beat. Just that over the last since the beginning of the year, okay, the dollar has been coming under a lot of pressure. And if Donald Trump has been threatening the Federal Reserve Chairman to cut interest rates, the market do expect to see that hustle between the Federal Reserve and the Trump administration. Okay, it's going to be chaotic because when you are trying to strong arm the central banks to do your bidding, that means to say that the central banks is not neutral. Okay, it is not independent. So from dollar Canadian, you can see that this is I'll show you the weekly time frame. Okay, we are also seeing a three-way pullback. So the three pullback has not found a bottom yet. The lowest it traded this past week is 140. Okay, and then we can see that the market has potential to test the 137 half to 139. So I do expect market eventually to grind all the way here, and that will complete a three-wave symmetrical ABC pullback. Technically, this is how I see it. But the one that we want to be concentrating on, if the dollar is coming off the way it is, so which currency right now is the safe haven currency? I think it's happening in the dollar Swiss. Dollar Swiss is long-term down. Okay, the dollar versus the Swiss franc is down. Then you say the Swiss franc is actually quite strong, but it is not trending. Okay, dollar Swiss is not trending, but we can see the demand for Swiss franc could be a reflection of the lookout for a safe haven currency. So I think the Swiss franc is probably the currency of choice right now for people to hedge against uncertainty ahead. Okay, so you can see the market has been locked between 0.83 to 0.93. So anywhere between this 1,000 pips, okay, the market is going to ding ding dong dong around here. It has been since middle of 2023. Okay, so this is definitely a pattern that we have seen over the last 20 months. Okay, so this is near term, this is going to be higher to sell, lower to buy. But selling will be a lot more safer than buying. Okay. All right, I'm done with the currencies. I think lots of you are looking at gold. Let me see where the gold market is. This is gold. Now, gold is interesting. Monthly, there's nothing to see here because it just shows that the market is still very, very strong. Okay. I think in the lower time frame, it'll be interesting, such as the weekly. I'll show you the weekly. The weekly now has a reversal pattern. Okay. A high of 3,167.5 is the all-time high. And that is followed by a reversal pattern. This is the pin bar. So immediately, technically speaking, we do expect prices to come off. If this week ends lower than the opening price of the 2 weeks before it, which is $3,021.40, that will be the confirmation that I need that we are beginning to see the start of a correction. Okay, this correction can last all the way to the first week of May. Okay, which I think by then, you want to be monitoring the situation in Middle East, especially if the US actually launch an attack on Iran. That will be major. Okay, launching attack on the Houthis in Yemen is already not enough to move the markets. Okay, but the Houthis has been very resilient. Okay, despite bombardment by the UK and the US, they are still able to launch counter strike on their US carrier group. Okay, so if the US actually launch a direct attack, okay, on Iran, that will be a different story altogether. That will bring the conflict to a whole new level. Okay, the Russian are already saying very openly, stop threatening Iran. Okay, so not sure whether that will lead to a real a wider conflict in the Middle East. If that's the case, that will be the catalyst for gold to go back up again. So if you are trading gold, watch the technical and watch for development happening in the geopolitical front. Okay, I think the market is ripe for the market to pull back. Okay, part of a very long-term bull market pullback. Let it pull back as deep as possible. I want the market to come back to as deep as possible. Okay, the timing is somewhere in the first week of May for the bottom to be in place. Okay, let me see. I do expect. I have some notes here. The target for me is about 3,004 for now. And over the longer period of time, it's going to be above 4,000. Okay. Yeah, first week of May, I suspect we probably will see a low in place. And if we see a low follow, accompanied by a reversal, classical reversal pattern, that is a signal to go back in again. Okay, I will be very interested. Okay, because I have missed this last leg of run-up prices. All right, Aussie, Roger Kumar is asking, why is the tariff causing US FX rates to go down? People are pulling out from US. You see, at the beginning of the year, we have a very clear situation in which outside of US, equity markets are doing a lot better in Europe and in Asia. Okay, and then they still, well, foreign investors still stay invested in the US. But after this tariff and the sell-off that we saw last week, foreign investors starts to cut loss in US equity markets. And when you sell off your US asset, you have no need for dollars. You will also sell the dollar and take your money back home. So they are correlated. If foreign investors do not want to be invested in your assets, they sell your assets, the next logical thing is to sell your currency, take back the money in their own domestic currencies. So this is exactly what we are seeing, why the euro, the sterling, the yen all been strengthening. Okay, so this is the result. Okay, so there is a correlation. You have to wrap your mind around this correlation here. Aussie, I've shown you Aussie. I have not shown you Aussie. Okay, so anybody has any question on gold? If not, I will revisit the Aussie again. The Aussie is dying. Now, this is the monthly time frame of the Aussie. Aussie long term is bear market. Okay, so we have that bounce followed by a pullback, but this pullback appears to be deepening. Okay, appears to be deepening. Okay. So where we are right now, in terms of closing prices, this is the lowest closing price we have ever seen. The Aussie versus the dollar. Okay. Yeah. So Aussie is definitely not doing well. Now let's take a look at the lower time frame. Take at the weekly. Now this week has been a little bit more volatile. Now currently the Aussie is quoted just below 60 cents to the dollar. Can it go down even further? I think it can go down a lot further because this past week there is another round of selling in the Aussie. So near term, it looks like all other currency has actually gained against the dollar, except the Kiwi and the Aussie. So these two currencies are not where you should be buying, playing the weak dollar game. Okay, you've got a better chance to make money by buying the other currencies like euro or sterling. Okay, but the Aussie is definitely not one of them. Even the Kiwi, let me visit the Kiwi for you. Here's the Kiwi. Kiwi is not doing even much better. Okay, it is close to the all-time low. Okay, in terms of closing price. The low traded was in September 2019. That was 0.55. Now where we are right now is at 0.5550. Not much higher than the all-time low here. So again, the Kiwi and the Aussie seems to be not benefiting from a weaker dollar. All right, currencies. Are we good for currency? Yes, let's go for silver. Next will be silver. Now, silver has been massively underperforming, but this is bad. Instead of charging the new high like gold, right now we have a three-wave rally, which did not even quite manage the ideal symmetrical target at $35 or $36. The highest it traded was $34.86 and then turned around. So this past week, in terms of this ugly bar here, it is quite similar to the one over here. But the other one over here, at least see another few more weeks of rally, see a few more months of rally. So I think at the end of the day, whether you want to buy gold or whether you want to buy silver, wait for May, all right, first week of May. So right now, silver has definitely not have the momentum to go higher. So it's definitely a victim of the sell-off in gold right now. Remember, gold sold off $151 from the peak, representing about 4.7, 4.8% from the peak to the closing. Okay, so this is quite severe in just 48 hours of trading. Okay, so in terms of the outlook, this is quite severe, right? This drop. So three-wave bare minimum will be targeting $28.40 or 45 cents. Anywhere between $28.45 to $27 could be the best outcome of this pullback. And then buy again. Okay. But I think in terms of the timing, maybe it will take a little bit longer than this. What we do not want to see for a market to actually accelerate to the downside, way below $27. Okay, that will be potentially very different outcome. But if the market do this pullback and stop somewhere between $27 to $28.50, I think that is okay. Because this is a classic three-wave followed by another rally attempt. Okay, this is my outlook for silver. Let's take a look at oil. This is the monthly time frame. If you have not already bought, maybe you want to look for opportunity. Okay. So far the bottom seems to be not able to hold. The last time it held was $65.50. Okay. One attempt, two attempt, three attempt, four attempt. Okay, but last week the market punched below $65 and go all the way to $60.24. So long as it doesn't break the $67, $57.63, okay, it remains a buy for me. If this market can go sideways without doing much of anything, but hold above $57.63 per barrel on a monthly time frame, I think it is still a buy. Okay. And if we have to wait for one more month, okay, for something bad to happen in the Middle East or Ukraine, by then, if that happens, then there will be the catalyst for a major surge in oil prices. I do see oil prices way above the all-time high now, by the way, based on the structure that we see. Okay. If the market do take out 127, 127, I'm not surprised. I do see oil going above $200 per barrel. That means a major escalation in geopolitics. Okay. Can that happen? I think we are beginning to see Europe preparing. Okay. We see UK, we see Germany, we see France, we see Poland, even Lithuania are basically getting ready for something big in Europe against Russia. Okay. So if any one of these two events, either the US attacks Iran or the members of NATO starts to directly attack Russia on their own, that could be a change in terms of oil pricing. It's no longer based on demand. It's going to be no supply. Okay, especially against Iran. Once Iran closed the Straits of Hormuz, whereby 40% of all the supply line have to go through, if they seal up that little gap at the Hormuz, then supply cannot come up to the marketplace. And that will be enough to cause price to rally. Okay. Uh, who else want to see anything else? Okay, let me cover Bitcoin just for once. Okay. Bitcoin has not really moved. Okay, so let me see where the Bitcoin is. Now, Bitcoin has been in sleeping mode. Okay, market did not really do much. Okay, so right now we don't see any kind of corrective pattern ending, but this is a very bullish market. So for now, the sell-off in equity market did not result in money flowing into Bitcoin. For some reason, it did not. Okay, so the market is waiting for something to happen. I don't know what they are waiting for, but right now there's no reaction in the digital space. So it's all quiet on the Western front. You can see on the weekly time frame, the market is just basically hanging on. Currently, it's trading at $82 and $82,500. Okay, I've also gone long on Bitcoin, by the way. Okay, I have a very, very small stake. Okay, because I think it is a three wave. On the weekly time frame, it's a very clear three wave, symmetrical, hitting a bottom at 76,800. So I went in to buy. Okay, but it has not moved yet. So hopefully something will move. Assuming this three wave holds, then it is logically the next move will be above 100,000, back above 99,467. That will be the first sign that the bottom is in place. Market is getting ready to rally and take out the all-time high there, just under 110,000. Can Bitcoin go to above 200,000? Technically, it can. Okay, so I had position waiting for the move to actually unfold, if I'm right. All right. And anything else? Because I think I'm coming to a tail end of my presentation. Oh, natural gas. I think natural gas is the one I have not updated. This is a new computer of mine. So I have actually redo all my analysis on this new computer here. Unfortunately, I missed out the natural gas. I'm so sorry, Anonymous. I will catch up with you next week. I will remember to update my natural gas right after this. Okay, if there's no other question, I want to end my session. Do you have any question? One last question for me? No? So going into the new week, expect fireworks because I think the sell-off in equity markets will likely continue. The trend that we have seen this past week is likely to continue into the new week. But watch out for Thursday. Okay, Thursday where the CPI number is released, it could signal a temporary bottom for equity markets. That's the main thing. Okay, thank you so much for your time, and I shall see you again next Sunday. Anonymous, I owe you your natural gas. I will update this on my chart. Thank you. Bye bye. Take care.